Right now, deep inside the massive legacy servers across Europe, an immense volume of institutional capital is quietly changing hands. Specifically, the Eurosystem's Target 2 network processes approximately 484 trillion euros every single year. By the third quarter of 2026, the European Central Bank plans to overhaul this settlement layer, moving toward a fully integrated European digital capital market. If you follow retail cryptocurrency forums, you will hear loud speculation that this move guarantees the adoption of specific popular tokens. The actual engineering documents published by the ECB tell a much more precise story. The Eurosystem is designing a strictly DLT-agnostic architecture for wholesale settlement. This framework relies on three structural pillars: a short-term bridging initiative called Pontes, a long-term infrastructure blueprint known as AI, and rigorous field testing by private operators like Axiology. Understanding these pilots requires separating a blockchain's underlying open-source mathematical code from the public cryptocurrency that trades under its name. Heavyweight financial institutions, including BNP Paribas and Santander, are actively running trials within these controlled environments. Every transaction executed in these trials must adhere strictly to the European Union's Markets and Crypto Assets Framework, or MiCA. Analyzing the mechanics of Pontes and AIA reveals exactly how the multi-trillion euro backbone of European finance is being rewired. The ECB's technical roadmap is built around one non-negotiable constraint: central bank money must remain the anchor asset for all wholesale settlement. This diagram illustrates the exact risk the ECB wants to avoid. The system intentionally blocks large-value tokenized markets from settling in private stablecoins or fragmented siloed bank tokens. Instead, the approved path routes all settlement directly into a secure layer of tokenized public money. The first phase of this rollout is the Pontes layer, targeted for 2026. Pontes functions as a direct bridge connecting external market distributed ledger platforms to the existing target services. When a tokenized bond settles on an external DLT platform, Pontes mechanically funds dedicated cash wallets directly from the bank's institutional target accounts, guaranteeing finality. While Pontes serves as the initial bridge, the long-term blueprint is a fully integrated EU tokenized market infrastructure, designated as AYA. Looking at this expanded AYA model, the system aims to automate 24/7 cross-border execution using smart contracts embedded directly into the central bank's infrastructure. Across both Pontes and AYA, the code explicitly mandates a DLT-agnostic architecture. It refuses to lock into a single proprietary blockchain. In fact, an audit of the ECB's official materials yields zero mention of integrating the public XRP Ledger or utilizing the native XRP token for standard settlement. The Eurosystem is designing an interoperable highway that can process data from multiple networks simultaneously, prioritizing total infrastructural control. To understand how this highway operates in practice, we examine the data generated by the private sector during the 2024 exploratory pilots. The firm Axiology sits at the center of these tests, acting as a crucial layer in the new European digital finance stack. Axiology's involvement sparked claims across social media that the European Central Bank was actively utilizing the XRP Ledger. This architecture tree shows the critical distinction between a public network and a permissioned fork. Axiology pulls from the open-source code of the XRP Ledger, but duplicates it to create a completely separate parallel network. That branched code is then sealed inside a closed, regulatory-grade environment, entirely under the control of private operators. This allows institutions to settle tokenized bonds and repos using the protocol's mathematical efficiency, while remaining strictly air-gapped from the public XRP network. Inside this closed system, the cash leg of every trade executes using a fully redeemable euro-backed digital asset, completely avoiding the price volatility of retail cryptocurrency. The infrastructure could interact with public tokens in the future, but only if developers explicitly construct a two-way bridge to allow that liquidity to flow in. Regulators like ESMA and the ECB mandate this closed-loop architecture because it guarantees that every transaction counts as legally final and enforceable under European law. The fact that central banks validate a protocol's mathematical efficiency does not translate to sovereign adoption of its associated public token. When we expand this view out to cross-border liquidity, the friction in the legacy banking system becomes mathematically impossible to ignore. This flowchart illustrates the current fiat routing model. A simple transaction moving Great British pounds to Philippine pesos relies heavily on passing through a US dollar reserve as an intermediary step. Because the conversion takes time, banks are forced to park billions of dollars in foreign sovereign currencies inside Nostro accounts, creating massive amounts of trapped capital. Distributed ledger technology replaces this linear path with parallel architecture, running the British pound and the Philippine peso in independent, highly aggregated order books. The infrastructural software sits in the middle and simultaneously matches trades on both ends of the corridor. It extracts the necessary liquidity and finalizes the payout in roughly 2 seconds, completely bypassing the need for a parked currency reserve. Crucially, this rapid settlement layer only operates when heavily regulated financial institutions maintain total compliance at both the origin and the destination. Strict prudential rules from the Bank for International Settlements dictate that institutional banks will not hold unbacked, volatile assets on their own balance sheets to provide this liquidity. The real breakthrough here is the software's capacity to orchestrate simultaneous dual-book execution, functionally eliminating the capital drag of legacy foreign exchange. These technical capabilities align precisely with the European Central Bank's push for long-term strategic autonomy in global financial markets. This modeling maps out 3 specific economic metrics verified during testing: drastically reduced counterparty exposure, real-time reconciliation, and heavily compressed intraday liquidity. Because the cash leg remains anchored in sovereign money, this efficiency perfectly harmonizes with the strict supervisory controls demanded by European regulators. The consensus from early confidential briefings among major banking partners is clear. This architecture will become the European standard. It will happen not because the central bank mandates it, but because the mathematical efficiency leaves legacy systems obsolete. What began as fragmented, isolated blockchain testing has rapidly matured into live, regulatory-grade institutional infrastructure. While retail markets remain focused on price speculation, the real story is in the code. Algorithmic engineering is quietly, systematically restructuring the multi-trillion euro backbone of the global economy.